Hello, welcome to our channel successfultradings.com. So today we are going to be showcasing to you what is an option chain. So by the end of this tutorial, you will learn about option chains, the importance of two Greek letter or variable, if you will, and how to use an option chain to place a trade. So without any further ado, let us go ahead and let's get started. So in here, this is I'm using the Power ETrade platform for trading options. So this year, that's what I'm going to use today as the means by which to show you what's an option change. So in this platform, when you come in, you can select your stock of interest. If you don't know the ticker, you can research the ticker yet. But typically here you can try to type in the name of the company, the stock you want to trade, and the ticker will show up. So in this case, I'm going to pick one of my top three stock to trade, Micron, that is, if you do not know that through some of our blog posts already. So when you select that, you have access to this. So here you see there are very complex option that can be traded. For the purpose of this training, we are just going to focus on the basic calls and puts. So when we select that, we have here to the right of it, you can see the number of strikes to select. So let's go ahead, for instance, and say, oh, we just want to see 4 strike and see how it actually updates. So 4, because we are looking at just 1, 2, 3, 4 strikes. If you want to see them all, or you just want to see a particular number, you can just select 10 in this case. Most platforms, they will provide you an option to do that. So what else do we need to know? We can put the price here usually will be the very price close to the current trading price. The market has been closed for a couple of hours now, so this is not during the live market. We will do a video at a later time during the live market. So basically, this is an option chain. The main thing here on the option chain, as we highlighted in the blog post, is the date of the option. So this here is December 19 is in reference to today because today was the third Friday of the month. If we are to look at options that's to expire next week, that will be the 27th. They will have the exact date. So the difference between these that expire the third Friday is that they don't have the specific date. They just have the month and the year next to them. We explained that in our tutorial. That's we gladly invite you to read and immerse yourself into. So this is the practical version of that tutorial here. So what else? These columns, let's talk about them. So we have our strike. In this case, we have selected 10 of them. Those strikes are centered around the price, the current closing price, that's $55. And notice here that's a Power ETrade to help traders out. The strike that are currently in the money, they are highlighted with this gray. I'm not sure if you can see that. So, and then the out of the money ones are not highlighted. That's really doesn't bear any importance. Just explaining reason why you see that line or differentiator there. So we have the dates here. You can select any type of expiration dates that you want. So let's click on this one and just select it. And next, we know that each row is for a specific strike, but really to get to the illustration purpose, let's really just select one tab, because here on the left hand side on this platform we can see the calls, and on the left hand side we can see the puts. On the right hand side, these are the puts radar here, and the calls on here. The reason that lapsus actually is going to show, let me just use this navigation here. If I click this way, I'm actually focusing on the calls. The calls are here. So one trick that we shared with you in the blog post is that this specific Greek that we're going to talk about, it's positive for calls. And if we go to the put side, it is going to be always negative. So whichever side that you prefer for this explanation, maybe let's start with the put side on here. So we have the current bid at the close, the bid, the ask, we explained those, and the last trade that took place, what was the ongoing price. And Macron is a very nice stock to trade in the sense that its options are very liquid, meaning you have plenty of volume. Plenty of volume. So to the question, what is the type of volume, or really it's not the volume, will be helping for something else during the trade. So to see if other traders, they're buying that specific strike or those options. But really we want to look at the open interest. The open interest is what will determine the liquidity of an option. So typically you want to see at least one of these with a number greater than 400, really. And we'll show you options that are not that liquid. You really will want to avoid them. I will show one at the end of this video. So you can select a strike, and then you will have the price that are on there. What's to know here? So these are things. This column, bid, ask, all the way through theta, are things that you can actually set up through the platform. So here through select column, at least on this platform, this is how it's done. So I can bring in, those are the ones that are brought in. So and let's go ahead and try to talk about them. So when you select them, then you can just save. So in this case, we talked about the open interest. That's important because it's an indication that other traders are interested in that, and that will make it such that the difference between the ask and the bid will be relatively close. I mean, this is as good as it can get. I know of another stock that I can give you, Apple, for instance. The delta between the bid and the ask will, or let me not use that word. The difference between the bid and the ask will typically be 1 cent. So that's really liquid. That's excellent. But this is not bad at all. This really among the top. So we talked about implied volatility. The implied volatility, which we can see the long-term trend of implied volatility is here. Right. So what's the difference between this number being high on the one that expired today? Well, because on the last day of expiration, the expected movement, it's always higher compared to, let's say, dates in the future. And typically, we also made mention that stock that have earnings. So if we were to have earnings on this week, you will see a spike on that. Let me actually try to go and diverge for a moment and find a stock that will be having earnings next year. In this platform, this is how I go about doing that. So I go to calendar, and so these were the earnings for today. So if I just click here to go show me next week, so next week there's not much activity that's going on. But let's take, for instance, this stock here, PIR. So PIR will have an earning on the 26th. So let me showcase what will happen on this. Sorry about this. So let's go back. So on this one, we have to go back to trading and options. So PIR is a stock that will be having earnings next. PIR. Okay, and we want to show the implied volatility if we are lucky enough. First of all, this actually helps us greatly. Well, this is not even available. You see here, let me actually find maybe even more, put in more strike. See what's happening on this stock? Look at the open interest. Look at the spread. Take a look at the spread here. The spread here is almost 100%, meaning I'm taking the difference between the ask and the bid, and I'm dividing that by the bid. That's too much. Very little chance, no matter what happened with this, to make money. So these are the type of stock to avoid trading option on. Really, not worth your time at all. Hope that helped on that. Let's return to Macron, where things are really definitely nice. So here's the implied volatility. The dotted one is the 30-day average, and the solid line is the current one. So this is a decent implied volatility at 20 something percent, but notice what's happening here. Actually, let's go back to this one. So these numbers are average overall, meaning that the average across all of the strike that's available. So this implied volatility here, let me reselect maybe just, okay, here we go. So that we can see everything. 20% implied volatility is good. It's one of all of the lowest, and the reason for this, because we say that there is a direct correlation between implied volatility and the price of the option, meaning the higher the implied volatility, the more expensive that option will be. And then we talked about a little bit about the implied volatility change, so meaning that when a stock is moving too fast or is expecting too much of a move during ER, this is a measure from the previous day. So it decreased overall, meaning the prices for these options became cheaper compared to yesterday. The stock was up today for a great deal. So we are looking at puts on here. We can see that. So we said that let's talk about the Greek then. Now that you have an idea about the what an option chain is made of. So the Greek, this is the delta. We said that it has two meanings, right? The first meaning of this is that if the stock is to move by $1, the price of this option that you are looking at will be moving by this much. You multiply that by 100, since each one of these option it's control 100 shares, so that will mean that this 55.5 put option, if the stock is to move by $1, it will be worth 95 or 99 cents, almost $1 plus the 59 cents on here. That's one way to interpret the delta. The second way to interpret the delta is that statistically there is a 59% chance that this Macron will be worth $55.5 by the expiration on this date. But so by December 27, there is a 59% chance that this option will be in the money. That's the other way to interpret delta. And then the second most important one, there are 5 of them as we talked about, but really focusing on the main one. This is theta. Theta, the meaning of theta is the time impact on your option. Options are very, very sensitive to time. That's how traders lose money, because hey, you are not tracking time, but your options can decrease in value very, very quickly. So here, this just means that each day that passes by, this option here, the 55.5 strike that we are showing, will, no matter if the stock is going down or up, this is automatic, its value will decrease by 5 cents. That's not bad actually. And typically, the closer to the expiration, the more the higher theta is. So that's just how options are built. So if you're interested, we can definitely talk about more regarding the statistic and the model that's used for the pricing of option. All of these other ones, I do not have any position on Macron for next week. So nothing, this is my actual accounts on here. Nothing is showing on here. These were the bids size and the ask size overall. So let's just go now through what if we wanted to place a trade. So we will go about it this way. So in this case, if I click on here, there is this menu that comes up. It's really not that scary or anything. This account doesn't have much money. As you can see, I use this account for really the purpose of trading. I'm showing you this type of example. So I consider that a trading account, if you will. So here we can adjust the number of contracts that we want to buy. The expiration date here is December 27. That will be for next week. The strike price we talked about, and puts. If we can toggle back and forth between calls and puts. So puts telling us that the bid that we saw here is 95. The ask is 99 cents. And the limits, if you want to place a limit order, you will put that limit price on here. You can put in a condition. What I like really about this tool, I'm going to do a review of it in another video, is that you can put in a condition that, oh, I want this to trigger when something happens. So my trigger will be here when, for instance, I can say when Macron, the last quote is greater than a certain price or is less than a certain price. And automatically that will trigger. And when it triggers, you then, let me cancel this and do that again. When that triggers, then your order is activated. It does not mean that it's going to be filled. It just means that your order is saved until a condition is met. So imagine a scenario where you're going to say, hey, I am bearish on this, and I'm going to say when it dropped below 54 and a half, then I know that I have a confirmation of the bearish nature of the stock, and thus I can then go with great confidence buy the put. That's an example of why that's critical, or that's helpful if you will. So this is how you will go about placing that trade. You limit order, and then you preview it, and in this case, okay, we don't have insufficient funds. Okay, so it wouldn't even take it because this is after hours. So that's really funny on there. Okay, because we don't have $99 to take that trade. So, but in any case, we can put a trade. Can take a trade. This one, for instance, 54, so $1 away, which is not that bad actually. It has a delta of 27%, meaning that it has a 27% chance of being in the money. And upon preview, the next screen will preview it, and you will be in your trade. So this again is a summary video or tutorial, if you will, to how to go about learning about an option chain, knowing about the two important Greeks, which are delta and theta, and also within Power ETrade, how to place an order for your option. So I hope you enjoyed the video. So please go ahead, comment, like, and tell us what you would like to see us review next time. Until then, have a great day. Thank you. Bye-bye. Hello, welcome to our channel, successfultradings.com. So today we are going to be showcasing to you what is an option chain. So by the end of this tutorial, you will learn about option chains, the importance of two Greek letters or variable, if you will, and how to use an option chain to place a trade.